The rate curves and silver plans that set your 2025 Covered California subsidy. Hello, I'm Kevin Knauss with InsureMeKevin.com out at Folsom Lake here. And these are Native American grinding holes that were right next to the North Fork of the American River. And these are pre-Covered California. And I will always get questions from my clients, why did my rate go up so much? Or why did my sisters go down so much? What's going on with all of this? And the rates are pretty complicated in terms of all of the inputs that go in to setting them. So first, we need to recognize that California is broken up into 19 different rating regions. That means each rating region, sometimes a single county, sometimes half of a county, has its own rates. So a health plan in one county may have one rate, and it may be a slightly lower rate in the county right next to it because it's in a different rating region. So that is part of the equation. Now, when it comes to the rate curve, the Affordable Care Act says that the highest health insurance premium for a 64-year-old can be no more than 300% of the lowest adult, which is 21 years old. So here is the curve, and you can kind of see how it's kind of flat until you get into your mid-40s and early 50s, and then it really starts zooming up. So that's part of the issue, is that the rates for every year that you get older will go up. And then this curve shows you exactly how much year over year your rate would go up. And pretty much all of the health plans use this particular template. So in the late 20s, you can see that, just getting 1 year older may see a rate increase of 3 to 4%, and then it kind of comes down, late 20s, that's when people are having babies. And then as you get into your late 40s, the rate year over year can go up anywhere from 4 to 4.5%. So right there, getting a year older, you may experience anywhere from 0 to a 4% rate increase without doing anything, just surviving for another year. Now we layer on top of that the Affordable Care Act consumer responsibility percentage. And the way this works is that the subsidy is targeted to make the second lowest cost silver plan a certain percentage of your household income. So if your income is below 150% of the federal poverty level, the second lowest cost silver plan should be 0. And in those instances, the subsidy equals the second lowest cost silver plan. Of course, you can take that subsidy and apply it to any metal tier that you want. But you can see as your income goes up as a function of the federal poverty level, the consumer responsibility goes up, and then all income over 400% of the federal poverty level, the second lowest cost silver plan is no more than 8.5% of your annual income. And then if your income goes high enough and the annual amount of the second lowest cost silver plan is less than 8.5%, that's when you get no subsidy. So as a reference point, for a single adult, 200% of the federal poverty level for 2025 is $30,120. So that means they should be spending 2% of their household income for the second lowest cost silver plan. So the subsidy would be generated to make sure that they pay no more than 2% of that second lowest cost silver plan. For a family of 4, in 2025, 200% of the federal poverty level is $62,400. So you can see how, the household size can make a big difference. But let's look at how the rates are changing and how the second lowest cost silver plan can impact your subsidy, because not everyone chooses a second lowest cost silver plan. Sometimes you're in a higher one, maybe you're in a gold or a platinum, maybe you're in a bronze plan. So I went through all 19 regions, and I looked at the rate for a 40-year-old, no subsidy, so these are the full rates. And then I picked up the second lowest cost silver plan for a 41-year-old in 2025 because that way we know that that age increase is built into it. And the difference is the age increase and any inflation increase, because all of the health plans usually apply an inflation factor across the board. And we can see in Region 1, those north counties, the Blue Shield PPO is the second lowest cost silver plan in both years. Change is $62 or 8.78%. So, and if you look at that across other areas, that's pretty much, you'll always see that 8.78% increase for going from 40 to 41 and the inflation. Region 3, this is where it gets interesting. Western Health Advantage was the second lowest cost silver plan in 2024. I believe Aetna was the least expensive, but Aetna had a big price increase. So Aetna leapfrogged over Western Health Advantage, became the second lowest cost silver plan, and the change in premiums for full premium, $86.70 or 16.5% increase. So when the second lowest cost silver plan increases its rate, the subsidies increase. So then let's look how that works out for this 41-year-old. Assuming that they selected the most expensive plan offered to them, which was the Blue Shield PPO, we know that was 8.78% increase, and they had in 2024 they were paying $544.23 after a subsidy, that APTC, of $359.28. In 2021, the subsidy increases to $457, a 27% increase, and their rate drops to $525. So a 3.5% decrease in their monthly health insurance premiums, because Aetna, with a large price increase, became the second lowest cost silver plan. We go looking at some other areas, regions 8 through 12. Region 9 is kind of an outlier because Valley Health Plan left the area. And when Valley Health Plan, which was the least expensive silver plan, left, that dropped everything down, and the very expensive Blue Cross EPO became the second lowest cost silver plan. And you can see that the Blue Shield HMO was the second lowest cost silver plan in 2024, but there was a change of $353 per month on the full premium, or a 57% increase for the second lowest cost silver plan. So what does that look like for a 40-year-old that is making $40,000? Well, the APTC subsidy jumped 81%. And this 41-year-old went from paying $452 in 2024 down to $166 in 2025, a 63% decrease. My goodness. So sometimes it's just, you just really don't know how this stuff is going to play out. Getting down into Southern California, Inland Empire. Now, I chose this one because Health Net remained the second lowest cost silver plan, had a very modest increase of 5.45% to the rates. But of course, we know that the individual got older, and I believe the age increase between 40 and 41 is about 1.8%. And then Blue Shield had about a 7% increase. So when we do the second lowest cost silver plan APT subsidy, it only went up a little bit, about 14%. But because the Blue Shield PPO went up so much more than that second lowest cost silver plan, that individual is receiving a rate increase after the subsidy of 5%, going from $371 to $391. So there's a lot of different things that go into determining these subsidies, and it isn't necessarily straightforward. So if you have any questions or comments, you may leave those down below and I will do my best to answer them. Otherwise, out here at Folsom Lake, I'm Kevin Knaus for InsureMeKevin.com.